Hello everyone and welcome back to Money Finance Wealth. Today we're tackling a crucial phase of retirement planning: withdrawal strategies. Before we dive in, if you're new here, please hit that like button, subscribe to the channel, and ring the notification bell so you never miss out on our in-depth guides to mastering your finances. We're all about providing you with the knowledge you need to build a secure financial future. Accumulating a sizable retirement nest egg is only half the battle. Equally important is having a solid strategy for withdrawing those funds in a way that ensures your savings last throughout your retirement years. This video will explore various retirement withdrawal strategies, helping you understand the pros and cons of each and choose the approach that best suits your individual needs and circumstances. We'll cover everything from the 4% rule to more sophisticated methods, giving you the tools to make informed decisions. Before diving into specific strategies, let's emphasize why having a withdrawal plan is so vital. One of the biggest challenges in retirement is longevity risk, the risk of outliving your savings. A well-designed withdrawal strategy helps mitigate this risk by ensuring you don't deplete your funds too quickly. Inflation erodes the purchasing power of your savings over time. A withdrawal strategy needs to account for inflation to maintain your standard of living. Investment markets can fluctuate, and a poorly timed market downturn can significantly impact your retirement portfolio. A withdrawal strategy should consider how to manage withdrawals during volatile periods. Taxes can significantly impact your retirement income. A withdrawal strategy should consider the tax implications of different withdrawal methods and account types. Life is unpredictable, and unexpected expenses can arise in retirement. A withdrawal strategy should include a contingency plan for dealing with unexpected costs. The ultimate goal of a withdrawal strategy is to provide you with the income you need to maintain your desired lifestyle throughout retirement. Without a well-thought-out strategy, you risk depleting your savings prematurely, forcing you to make drastic lifestyle changes or rely on other sources of income. The 4% rule is a widely known and often used guideline for retirement withdrawals. It suggests that you can withdraw 4% of your initial retirement portfolio balance in the first year of retirement and then adjust that amount each year to account for inflation. For example, if you retire with a $1 million portfolio, you would withdraw $40,000 in the first year. In the second year, you would increase that amount by the rate of inflation. If inflation was 3%, you would withdraw $40,000 plus 3% of $40,000, which equals $41,200. The 4% rule is based on historical market data and is designed to provide a high probability of your savings lasting for at least 30 years. Pros of the 4% rule: simplicity. It's easy to understand and implement. Historical support. It's based on historical market data and has a good track record of success. Provides a consistent income stream. It provides a relatively stable income stream that adjusts with inflation. Cons of the 4% rule: not a guarantee. It's not a guaranteed solution, and there's still a small chance that your savings could run out, especially during periods of prolonged market downturns. May be too conservative. In some market environments, the 4% rule may be too conservative, leading to lower withdrawals than necessary. Doesn't account for individual circumstances. It doesn't account for individual factors such as your life expectancy, risk tolerance, or spending needs. Ignores fees. It doesn't explicitly account for investment management fees, which can eat into your returns. The 4% rule is a good starting point, but it's not a one-size-fits-all solution. It's important to consider your individual circumstances and potentially adjust the withdrawal rate accordingly. Before we move on to other strategies, it's crucial to understand a concept called sequence of returns risk. This refers to the risk that poor investment returns early in retirement can significantly deplete your savings, making it difficult to recover even if market conditions improve later. Imagine two retirees, both with identical portfolios and withdrawal rates. Retiree A experiences a series of negative returns early in retirement, while retiree B experiences a series of positive returns. Even though their long-term average returns may be the same, retiree A is much more likely to run out of money because they're selling investments at a loss early on. Sequence of returns risk highlights the importance of having a flexible withdrawal strategy that can adjust to market conditions. Dynamic withdrawal strategies are designed to address the limitations of the 4% rule and sequence of returns risk. These strategies adjust your withdrawal rate based on market performance and your portfolio balance. Percentage of portfolio method. This involves withdrawing a fixed percentage of your portfolio each year, regardless of market performance. This provides a more variable income stream, but can help protect your savings during market downturns. Valuation-based withdrawal. This strategy adjusts your withdrawal rate based on the current valuation of the market. When the market is overvalued, you withdraw less. When the market is undervalued, you withdraw more. Required minimum distribution, or RMD. Method involves withdrawing at least the RMD amount from your tax-deferred accounts and, supplementing that with withdrawals from other accounts as needed. Guardrails method sets upper and lower limits, or guardrails, on your withdrawal rate. If your portfolio performs well, you can increase your withdrawals up to the upper limit. But if your portfolio performs poorly, you must decrease your withdrawals to the lower limit. The Guyton-Klinger method is a more sophisticated strategy that combines elements of the 4% rule with dynamic adjustments based on market performance and inflation. It uses decision rules to determine whether to increase, decrease, or maintain withdrawals based on market conditions. Pros of dynamic withdrawal. Strategies, flexibility. They can adapt to changing market conditions and individual circumstances. Reduced longevity risk. They can help reduce the risk of outliving your savings. Potential for higher withdrawals. In some market environments, they may allow for higher withdrawals than the 4% rule. Cons of dynamic withdrawal strategies. Complexity. They can be more complex to understand and implement than the 4% rule. Variable income stream. They may result in a more variable income stream, which can be challenging for some retirees. Requires monitoring. They require ongoing monitoring and adjustments. Choosing the right dynamic withdrawal strategy depends on your individual preferences and risk tolerance. Taxes can have a significant impact on your retirement income, so it's important to consider tax-efficient withdrawal strategies. Tax-efficient asset allocation. Consider holding different types of assets in different account types, taxable, tax-deferred, and tax-free, to minimize your overall tax burden. Roth conversions. Consider converting some of your tax-deferred retirement savings to a Roth IRA. While you'll pay taxes on the conversion, your future withdrawals will be tax-free. Qualified charitable distributions, or QCDs. If you're over age 70 and a half, consider making charitable donations directly from your IRA. These distributions can satisfy your required minimum distributions and reduce your taxable income. Tax loss harvesting. Consider selling investments that have lost value to offset capital gains taxes. Consider state taxes. State income taxes can vary significantly. Consider the tax implications of where you choose to live in retirement. It's best to consult with a tax advisor to develop a personalized tax strategy for retirement. Most retirees have savings in different types of accounts, each with its own tax implications. Taxable accounts. These accounts hold assets that have already been taxed. Withdrawals from taxable accounts are generally taxed only on the capital gains or dividends earned. Tax-deferred accounts, such as traditional 401k and traditional IRA, hold assets that have not yet been taxed. Withdrawals from these accounts are taxed as ordinary income. Tax-free accounts like Roth 401k and Roth IRA hold assets that have already been taxed, but withdrawals, including earnings, are tax-free. A smart withdrawal strategy considers the tax implications of each account type and prioritizes withdrawals in a way that minimizes your overall tax burden. A common strategy is to withdraw from taxable accounts first, then tax-deferred accounts, and finally tax-free accounts. No matter which withdrawal strategy you choose, it's important to build flexibility into your plan to account for unexpected expenses or changing circumstances. Maintain an emergency fund of at least 3 to 6 months' worth of living expenses in a liquid account. Develop a contingency plan for dealing with unexpected expenses or market downturns. This might involve reducing discretionary spending or temporarily suspending withdrawals. Review your withdrawal strategy at least annually to ensure that it still aligns with your needs and goals. Retirement planning can be complex, and choosing the right withdrawal strategy can be challenging. Consider seeking professional advice from a financial advisor who can help you develop a personalized plan that meets your specific needs and goals. A financial advisor can help you assess your financial situation and risk tolerance, develop a retirement income plan, choose the right withdrawal strategy, manage your investments, and minimize your taxes. Planning for a comfortable and financially secure retirement involves more than just saving. It requires a well-thought-out withdrawal strategy. Speaking of guidance, we'd like to thank Fennel Wealth Management for sponsoring this video. If you're looking for personalized financial advice and wealth management solutions, their team can help you navigate the complexities of retirement planning and build a strategy tailored to your specific needs. You can reach them at 888-336-8586, email info@fennel.com, or visit their website at fennelwealthmanagement.com. In summary, a successful retirement withdrawal strategy is essential for making your savings last throughout your retirement years. By understanding the different strategies, considering your individual circumstances, and seeking professional advice, you can create a plan that provides you with a secure and fulfilling retirement. Thanks for watching Money, Finance, Wealth. We hope this video has helped you better understand retirement withdrawal strategies. Remember to consult with a financial advisor to determine the best course of action for your specific situation. And before you go, please give this video a like, share it with your friends, and subscribe to our channel for more informative content on all things money, finance, and wealth. Your support helps us continue to create valuable resources for your financial journey. Thanks again for watching, and we'll see you in the next